Hello and welcome. I'm David Adams and this is my Q4 2012 market update. Alright, so the end of the year is winding down and there's a lot of excitement with the election just a couple of weeks away. Maybe for some of you it's anxiety, but I'm excited. Perhaps I need a new hobby, but it is what it is. So, I know a lot of you think that this election really means life or death for this economy and perhaps the stock market. And while I do agree that this is a big one, and it's very important and symbolizes a turning point perhaps for our country, don't give the politicians that much credit. Now what do I mean by that? Simple. Our country has seen many different types of presidents, and it's never quite as good or as bad as we think it's going to be. The beauty of this system, giving credit to our forefathers or founding fathers, is that it's something called checks and balances. So gridlock is and always has been frustrating, but it is a mechanism that really prevents any one party or one president or person from changing what our country stands for. Now I can just feel some of you rolling your eyes right now saying, David, you just don't get it. This is really going to make or break us. I absolutely disagree. In fact, I'll bet you lunch or dinner at McDonald's that you'll still be reading my newsletters and putting gas in your car and picking up your kids from school. And my point is, things are not going to change as much as you think. Spend time with your loved ones. Focus on the things that matter. You are in control of how you spend your most precious commodity. And what is that? You always hear me talk about time. Time is your most precious commodity. Focus on that. Okay, I'm done playing Dr. Phil. I wanted to start this quarter segment with a From the Heart David moment, and there you have it. Oh yeah, and one of my favorite clients just the other day came up to me and said, you know what? We were talking about politicians. It's about time that somebody either leads, falls, or gets the heck out of the way. And that was a nice way of putting it, but I absolutely agree. This country is longing for a leader. Alright, now it's time for a bunch of boring David facts and figures and nerdy stats. Here we go. Oddly enough, not a lot has changed since my last update 3 months ago in regards to the economy. The market has continued a nice little surprise rally, double-digit returns in the S&P, a pretty good year for a balanced, well-diversified portfolio. Unfortunately, I know some of you that are my clients, feel or sense some sort of skepticism and uneasiness towards this current rally, and feel that maybe there's some air under it, and especially if there's any sort of negative media world events kind of headline risk that could happen, and I agree, that is a concern. However, let's focus on the facts at hand and a few positives. I spent a lot of time the past couple of weeks with some higher ups at JP Morgan Asset Management, and they reminded me, just as with last quarter, and I said this last time, the U.S. economy is slowing down, but it is not stalled out. And I agree with this, but the big question really really has to do with, does the U.S. avoid the fiscal cliff that we all keep hearing about? And more to come on that, because that's a big one. So I always talk about 4 different cyclical sectors that really affect the economy when I'm talking about the state of the economy. Light vehicle sales, private inventories, capital goods orders, and housing starts. All of these seem to really be slowly working their way towards their trend line, with the exception of housing. Housing starts average usually around 1.4 million a year, and they're currently around 750,000 as of August, and that's according to the U.S. Census Bureau. So this is exciting, or not exciting, but it's still a positive. Now as it relates to housing, what really blows my mind, and this is again according to the U.S. Census Bureau, that the average rent payment for consumers is around $725 a month. Compare that to $500 for the average mortgage. Yes, folks, you heard me right. It's cheaper to own a house than to rent a house because of the low interest rates. So because of that, I think housing is going to continue to creep along. And according to the Federal Reserve Board, because of these reduced mortgage payments, as a part of the average consumer's balance sheet, the personal savings rate is up to around 4.2% compared to around 2% in 2005. And the consumer's household debt as a percentage to their income is now around only 10%, whereas it was around 14% at the market's 2007 peak. So moving on, let's talk about Europe. So Europe's still ugly, but it's priced for ugly. And I really think this is going to continue to be the case for years to come, but at least they've shown some sort of interest
in keeping some of these crippled countries from imploding. Remember, Germany, even though despite their fiscally conservative ways, they still remain stuck in this mix because of the large percentage of exports that they have in regards to, or in relation with other Eurozone countries. So basically what I'm saying is they're all in this mess together. Now the next positive that I want to point out is in regards to domestic valuations, as well as some developed and emerging markets. Generally speaking, valuations remain undervalued, meaning there's some room for growth still. And according to Russell Investment Group, large cap blend stocks, as an example, are still about 20% below their historical average. Now bonds. All of you keep asking me about bonds, and I'll just say I think bonds are still expensive, and I've been saying for 2 years now that bonds have been part of a 30-year asset bubble, and there's really nowhere for them to go with interest rates being close to zero. That being said, in order to get some type of interest or meaningful yield from your bonds, you really need, in my opinion, to look for tactical and strategic managers and be willing to sacrifice some credit quality and look at areas like high yield bonds. I would not lengthen the duration of your bonds, but instead I want the managers that are nimble and can keep low durations and get the yield again through diversifying their credit risk. Very, very important. Okay, so the big elephant in the room, the fiscal cliff. We keep hearing about it. This is basically what happens if Washington does nothing, imagine that, and they let the Bush-era tax cuts expire, and then automatic spending cuts go into effect. I don't think this is going to happen, really under either party's victory after the November 6th election, and really because I think this would automatically take us back into another recession, and I don't think either party wants that. The way it's avoided is through higher revenues. Now, the difference between the two presidential candidates is how they believe we get the higher revenue stream. President Obama believes that by increasing the tax rates on the wealthy, as defined by those of us making over $250,000 a year, this is a solution. Governor Romney, on the other hand, believes that by closing the loopholes on the wealthy and then decreasing rates for everyone at around 20%, this is going to bring in more revenue because people and businesses are going to grow more, make more money, and bring more business back to the U.S., thus increasing the federal government's share of revenue. Folks, these are two night and day differences of opinion on fiscal policies, but both are aimed at the same thing, and that's helping to close the deficit, which we have to do. So I'll digress, especially on politics, and let's hit a few points about taxes. I can't help it, it's the CPA in me. I love taxes. I really need a new hobby. I'm going to work on that. Next quarter I'll have a new hobby, and it won't be taxes and it won't be the election. So remember, our 2012 budget has us bringing in around $2.4 trillion in taxes and spending about $3.6, thus borrowing about $1.2 trillion a year. Rates are historically low on taxes. I don't know if anybody remembers, but under Kennedy, I believe the highest tax rate was around 80 to 90%. Also remember that the top 5% of wage earners pay 59% of the taxes. 47% of U.S. citizens pay zero taxes, and this is according to the U.S. or to the IRS Tax Foundation. If taxes go up, the highest rate more than likely would go from around 35% to around 43%. All right, now I'm stressed out. I'm tired of talking about taxes and the election. I need to go relax and unwind. So let's stop there. I hope to see each of you at our team holiday party, or also some of our post-election seminars, which we're holding. You'll get more on that. And while I can't control the stock market or the election, haven't figured out how to do that yet, I can control making sure that my team is the best at what we do, and that we stay on top of the market and our most important, or stay on top of things for our most important assets, and that's you, our clients. Information is always power. We will continue to give all of it that we have. Enjoy the holidays, your family, the important things in life, okay? Challenge yourself, and I'm going to work on this as well, to not worry or think about money, heck, even just for a few weeks. But don't spend it all either. Until next time, I'm David Adams, and this was my Quarter 4 2012 Market Update.